Let's have a walkthrough of a business valuation model that has been created. My name is Victor, and I will be walking us through this corporate finance model that I built with business valuation. The company we are using is Nestle Nigeria. Please note that this is only for learning purposes. No decision should be made based on this. If you want to go ahead and you want to invest in the company, we advise that you go ahead and do your further due diligence. So this is only for learning only. So let's get started. We have four segments. So input section, so you can see what this black section is referring to. We have the calculation, we have the financial forecast, and we have the business valuation. And we are working with only DCF for the purpose of this. From the start, here we have the admin worksheet, and this is just giving information about the business. Let me zoom out for us to see about the business. Also, the model legend, more like you understanding how to navigate through the model. You have your input sales style, sell link, formula sales, like that. Also, we've created a check. So most time when you're building your model, it's always good you create checks so that will help you to keep your model uh, check at every time you make changes. Then you have the table of contents. So we have the admin, historical financials, historical analysis, which we are going to go through one after the other. And also you can navigate from here. Let's say we're going to the forecast income statements. It brings us here. And on each worksheet, you can also navigate from there by just clicking on this for us to navigate to where we want. So let me go back to the admin worksheet. Now, modeling is also uh, evolving, right? Which means there's more that you need to do whenever you build model. It's not where you just build a model and you leave it. Now we have AI. For example, I did some magic with using Copilot to kind of create some good, interesting reports. Build the model, uploaded it on Copilot, and I just asked it to create some kind of investment research report and all those things. So things like this, if you can include it in your model, it's kind of add value to it. Yeah, your user might not have time to go through each of the worksheets, but the kind of reports we really make it interesting. So now this particular worksheet, you can see forecasts and valuation reports. So we have executive summary, we have the historical report, performance analysis, we have the forecasts, key operating and the macro assumption that has been used in the model, and then we have brief explanation on the valuation DCF and also the scenario approach that we've included. So with this, someone can decide to just sit down with this and decide to read through only the report, right, and ask any question they want to ask without having to go through each of the model. So this is a sample report. I'm going to make this workbook available so that you can go through each of them, each of the worksheets to understand how we've created it. So you can also see the conclusion. So that's here. What's our conclusion? Are we recommending that they should buy or they should sell? So even from the top here, you can see buy. The target price is 1,200, which is naira because it's operating in Nigeria. The current market price, this is what it's saying. So that is giving more like an upside of plus 30.6, right? Which means the current market price is lesser than the target price. So which means you can buy that. Also the same thing as EV to EBITDA is below average. So just an overview of what you've built into the model itself, right? So for example, revenue grew rising from 287 billion in 2020 to 595 billion in FY 2024, then representing a compound annual growth rate of 35.2 and average revenue of 27.7 over the historical period, and driven primarily by volume expansion and pricing adjustments. So which means we're not just giving the report, you're also giving insight as to why something happened. So year-on-year growth accelerated materially in 2024 at 75.2, reflecting inflationary and FX-driven pricing reset. So can read through this. I said this is just a walkthrough. I'll make sure I make the workbook available so you can read through this. Okay, now let's go to the summary. So summary here, it's easy for us to see everything at a glance. Okay, so we've also included some different scenarios. So I think we have like 10 different cases. So scenario one is like base case. Think what did we do? So we go to when we get to the scenario part, we also look at it. But at a glance, here it's easy for us to see what the enterprise value is, our model outputs, and what the market's data is. Now, remember, valuation is done at a point in time. So this was done as at December 31st, 24. So as I said, it's only for learning purposes. So that's why I'm not using any of the latest financial. So we are just saying, oh, let's assume we are valuing this as at 31st December 2024. So which means every data we've used represents that point, 31st December 2024. Now the decision is simple. So because you can see currently now market value is saying yes, the market's enterprise value is undervalued by 17.2, while the equity value 30.6. So the share price, our model is saying, is worth 1262, while the market as at that day was 875. So which means you can go ahead and buy because it's currently being undervalued. So which means we expect the business to perform better in the future, thereby that we adjust the market value. I think if you check the share price today, think they are close to 1002 or even higher than that, right? And that's one of the reasons why we built typical corporate model and doing a practical valuation, right? So which means if I've decided that okay, the market is currently being undervalued, let me buy it. So by the time market adjusts to that in the future, then I have my gain. So this is the work that has been used. 26.8. Am I conservative? Is it too? Is it on the low end? Is it on the high side? As I said, this is only for learning purposes. I can always do your own due diligence to be able to get. But I kind of feel comfortable with it. So as I said, that was as at point 2024. Yeah, the economy of Nigeria was kind of shaky this period, and there are a lot of things that was happening. So I felt comfortable with that. Cost of equity 31.3, cost of debt. Then we have the terminal growth rate of 14%, which represents the Nigeria long-term inflation rate, and that's why if you say my WACC is high, yes, my terminal growth is also high. Okay, so to this side we have the average, just to have overview of our assumptions, the performance, and if that makes sense. So revenue growth historical from 2020. So we have 5 years historical. Is that 5 year or 5 years? 20, 21, 22, 23, 24. Don't mind me. Can be bad at numbers. No, I'm not bad at numbers. Counting. But this is 5 years, by the way. Then we have the forecast, which is also from 2025 to 2029. Okay. Revenue growth, historical average 24. Historical 29.7. Our forecast is 24. So which means we are on the conservative side of it, right? Then cost of sales, historical was 60.6, and we expect for our forecast to be 62.5 because yes, there's increase in inflation factor and also the volatility of FX which might affect their cost. Then gross profit margin, historical was 39.4 and forecast 37.5. So it's easy to just see what we've done. So we also have our EBITDA. Our forecast is also seems to be lower. Operating margin, but profit before tax for the forecast seems to be higher, and this is also coming uh, from the FX loss which they had historically. I think Nigeria is getting to a stable state. Even the currency is adjusting and is appreciating. So we hope that will also have impact on them positively, and also that same effect drive net profit margin. Capex to revenue, which is also good driver, core driver for revenue, historically was 6.7, so forecast 6.8. So we expect them to keep investing the same way they've been doing historically. Net working capital to revenue, forecast wise, we expect them to be able to adjust their working capital, which they've already started in FY 2024. Okay, so if you look at also the compound annual growth rate, right? our forecast seems to be on the lower side as compared to the historical, which kind of gives some sense of comfort. All right, so also we had a look at the share price of our model, which we forecasted. So the minimum share price, so there's like a data table that we created to test different scenario and changes in the core factor. So minimum is 754, which we don't expect them to to be to rise, because as at that time market price was 875. So on the median, 1 2 on the average, then on the max. So and we look at what the market price is as compared to those ones. Also the same thing for the enterprise value. As at the point where we are doing the valuation, this is what the market is saying, right? And this is what our own model is saying. As I said, one key uh, driver of revenue is the total capex, right? Because they just need to keep investing, and they just have to do that, right? It's a typical common practice of a corporate organization. And we can look at it. So historically, from 2020 to 2024, the capex to revenue 7.8%, right? Why? So which means if you look up the revenue and also the capex that was spent, capex 7.8.8, and we're saying for the forecast, right? And that should be the total here. So we look at the total capex to total revenue generated within those those period. All right, so this side, we're just looking at the decision making, like, hey, you know what, this is the model share price, this is the market share price, buy because it's currently undervalued. We also have the EV to EBITDA multiple. So we look at what the global FMCG peers EV to EBITDA multiple look like. This is what the model uh, has given to us, right? Which is on the somehow on the low end. Okay. All right, so which this is their historical. I think that, yeah, this is their historical EV to EBITDA multiple, and this is what the model is saying. So I feel the model is still conservative. Also, the model equity value to market cap, you can also see that, and also the free cash flow to revenue, both historical and forecast on the average. Beside here, we have good looking chart. So we have the revenue, right? And one good thing about chart is we need chart to be able to tell more story. Here we have the revenue and year-on-year growth rate. So you are not just seeing the revenue, we are also seeing the year-on-year growth rate. So for our forecast, we just stick with 24% on average. I said this is only for learning purposes. So yes, I just used what was comfortable, what I felt was good. So yeah, that is what we have. And on the EBITDA, so you can see the EBITDA itself, and you can also see at the top of it the EBITDA margin. So you can see that we are still on the good side of what the historical kind of look like. And also on the net profits, you can see the net profit, and you can also see the net profit margin on it, so that it kind of give you that overview understanding at once. Also debt to equity, right? And the debt was measured as total liability to the equity ratio, and this is what that look like. Okay, it seems the business really raised a lot of debt in 2023 and 2024, but we expect that to be able to normalize back, expected, right? So yeah, while we are doing the business valuation, this, if you are doing some other uh, viability analysis, then this might have higher impact, right? On the, for example, on cash available for debt service and things like that. So we also have the cash balance and the free cash flow to revenue. So this is the cash balance historically. This is what we forecasted in the forecast period. Also what the free cash flow to the revenue kind of look like. And to the other hand, right, our summary is well detailed, so even someone might decide not to go through the whole model and be able to understand what is going on. So here we have a table for our forecast financial, right? So key income statement, balance sheets, and cash flow. So you can see everything all at once: revenue, gross profit, EBITDA, okay, capital employed, net debt, total equity, debt excluding lease, then cash from operations, and you can see the free cash flow to the firm breakdown, and also the metrics for the forecast period. So it's such a well detailed summary. I wasn't sure I had as much as this while while I was creating it. But yeah, such a good run. So someone can decide to just go with this and use it to make decision. But let's go through how we've been able to create these. On each of the worksheets, you also see something like a summary view. So one where you can select your scenario, the EV to our enterprise value, you can see the share price, you can see the discount factor, and maybe the description of the case. And also you can see what, just comparing that to what the markets kind of look like. Here is where we have the extracted income statement from 2020 to 2024, right? The income statement as presented. So the same thing balance sheet and the same thing cash flow. Now, as we know, when it comes to business valuation, there's something we call analyst report structure. Okay, we have accountant structure which is based on standard, but for our own business valuation, we have the way we would like to see the financial being presented so that we can see those key core line items. So here, this is where we just have to do the historical analysis. Now, the purpose is not to change any of their figures or values. We are not auditing what has been audited. We trust their value, what they've done. All we just want to have is to have it in structure that is well pleasing to us to look at those key metrics, right? For example, you look at what has been presented here, it's very hard for us to see where the EBITDA is. So things like that, right? Hard for us to see where is depreciation line is. So what we have to do is to now do like a proper restructuring. And here you can see we have the revenue, we have the EBITDA, you can see your depreciation, you can see your operating income. So those lines are kind of pure, and also it's easy for us to be able to compare using this to another company. So it's basically saying we are putting all of them in the same structure, all right, for comparison sake here. So we have that, then we have the analysis. I said we are not changing their values. At the end, their profits for the year is still the same with what they've presented. Also the analysis of what the historical performance kind of look like, we have notes in the report too, so in case you want to go through that. Then the same thing for balance sheet. Balance sheet is okay, but because of some line item, for example, you have long-term receivables in non-current assets and receivables in current assets, right? But the basic understanding of anything receivable is basically current assets. But most times, because of naming and also because of standard saying, because of timing, you put this under here that because it's due over 1 year. But for the purpose of our own model build, receivable is receivable. So we just try to merge those same type of line items. So below here, you can see that we have a restructured line item. Okay, the balance sheet, the figures are still the same. And below here, we now have a further valuation balance sheet view. So where you can see these are capitalized assets, these are net working capital line item, these are net debt, right? This you can see the net asset and you can see the total equity, so that it's easy for you to see at a glance. Also, we have our cash flow, right? So the cash flow has a lot of line item which we might not be able, which might not be applicable to our own forecast. So what we have to do is to just restructure it to more like regrouping those line items so that we have key line item needed. And that's what we have there. We also included scenario. Should scenario come first or input? I think input should come first, but since we have it like this, that's fine. So we have to create, we've created like a 10 different scenario that can be incorporated into the model. First, for the income statement, we have the revenue. Let me open this. Yeah, so these are just the name of the cases where you can update your scenario description in here. Then the income statement sensitized. So we sensitize revenue, cost of sales, SG&A, and up here you can also see base case as we have it in the model. So increase in revenue. So we are saying what with 5% increase in revenue, what would the impact be on the share price? So if I put this to case two, that increased significantly, right? So case three is saying, so our case three is saying increase in cost, both variable and fixed cost, which are majorly our cost of sales and SG&A. So let me put that with every other thing being constant. That's case three, and that is giving us 862, which is even lower than our market share price that period. So also for the balance sheet, we're sensitizing both the capital expenditure And also case 5, we are sensitizing the working capital days, right? Also, there could be an increase in discounts. So let me say weighted average discounts increased by 10%. That's case 6. What will the impact be? So 873, every other thing being equal, right? So that's one good example of using a scenario. On the part of the input, it's quite straightforward, right? And you can see here what the historical data kind of look like: revenue, cost of sales, SG&A, and also their driver, percent of revenue, year. So you can see it's quite easy for you to walk through and also understand. So we have what the historical value kind of look like, and then what the forecast data points we are using. The same thing for balance sheet line item. So they're quite straightforward, easy to understand. And here we have the calculations, also quite straightforward, easy to understand. So as I said, I will drop the link to the file. So for, as I said, for learning purposes, and you can go through it, replicate it, and that's one of the best way you can also learn if you want to learn corporate finance or anything modeling, right? You have a sample like this, then you try to recreate it from scratch on your own. So this is our forecast income statement, what that looks like historically, and also for the forecast period. Then some key metric ratios, compound annual growth rates, and also the average of the ratios that we've used, right? So basically, I feel the business will still perform better, but let me leave that to when we are reading our summary or our reports. So the same thing for the balance sheets. So I've kept both the valuation balance sheet view and also the analyst balance sheet view. So we have both of them here, and below it we also have our balance sheet analysis, right? The structure of the balance sheet, what that looks like, and some key balance sheet ratios that we have there. Also the same thing for the cash flow. We have the cash flow historically, and we also have the cash flow for the forecast. Okay, so as I said, yes, while we are not focusing on, because we are doing business valuation, so we are not focusing on some key thing around that financial restructuring, the structure of their balance sheet, which could have significant impact, especially changes in that debt structure that is coming in and how much they are repaying, then the FX rates and what those impacts would be on their cash balance, right? So for example, in 2023 they have cash balance of 167, so everything is presented in million naira, and that dropped significantly in 2024, right? And one of it is the debt repayment, which was on the high end. Also cash flow from operation reduced significantly, and that is also coming from, so if you go to the income statement, we can see that in year 2024 the net exchange loss alone, look at what that looks like, and also increasing that interest expense line item. Okay, so now to the business valuation. We just created a simplified valuation. Why am I saying simplified? But yeah, so because one, if we come to the income statement, the reason why I'm saying we created a simplified one is you can see in 2023, so because they had a net loss, and same thing in 2024, their tax was positive, so they had like a tax credit, right? So which means going forward in our forecast, we also need to be able to determine, because if we are applying our terminal infinite growth on it, it's basically saying they'll be enjoying that tax benefit to uh to infinity. So typically what we usually do is we kind of create like a tax schedule to see, oh, this is the tax in the period, this is how much loss they might have left to enjoy over the period and things like that. But as I said, I've just kept this simplified for us, right? And there's some adjustments we might want to do to some line item, but let's keep it basic. And as I said, only for learning purposes. So I might be wrong, I might be right, I might be, just take it as as a learning point. So yeah, and here we have a valuation output and some key metrics. Then below is where we've created our data table to kind of check what the impact of changes in both the discount rate and the terminal growth will be on share price, enterprise value, and equity value. So I think below here I did one um, adjustment for the tax, right? Also, those type of adjustments are what we incorporate. And for our discount factor, you can also have a look at the discount factor. So I said for learning purposes, so most of the data I've used are publicly available data and some from down websites for us to use as a base. Okay, so here we have the historical share price, what that kind of look like, and we just put that for our summary view. So here on the report, it's easy for us to read through what's happening to the firm. Right, as I said, Copilot was also used to create this report. So what I did was, after building this model, right, properly well structured input in only one worksheet, calculations in one worksheet, forecasts in each worksheet, and my valuation sits in one worksheet, uploaded it and asked it to kind of looking through it, right, to create that report. So it created the report. Yeah, do I have to rewrite the report to kind of fit into some things? But these are benefits of what we can use our copilot to achieve in our model build. So yes, once again, my name is Victor Ogundele, and what we've done is to have a walkthrough of a business valuation that has a decision at the end, that are we going to buy the stock of this business or not, and every other thing being equal, this is looking like a good business. So remember, this is only for 2024, so it's only for learning purposes. So thank you, and I hope to see you in my other videos.